Hello, everyone. How are we doing today?
Good.
Good. That's by far the most responsive that I've gotten out of class today. I talked to my AIS class today, the graduate class this morning. I said, "How are we doing?" It was like, okay. It was one person. All right. Then my AIS class was a little bit more receptive. I had like 4 or 5 people, and then pretty much everybody here was engaged. I guess the further we get into the day, the more awake people are, the more awake and engaged. Or maybe you all are just exceptional. Well, we can go with a little bit of both. How's that? We got a lot of stuff to talk about before we get started today, so let's go ahead and do that. Last reminder, Career and Internship Expo is taking place tomorrow from 11 a.m. to 3 p.m. over the Student Union. If you did not do Meet the Firms, this is your opportunity to get that extra credit, and I encourage you to do so. If you went to Meet the Firms, you're more than welcome to attend. You just won't get any additional points of extra credit. Please report to me if you do go to the Career Expo, as I will not receive a sign-in sheet for that. I can't check that one. I already mentioned that we're going to have a visitor on October 6th, and I changed the syllabus. So there's a few things that I want to talk about with that. First of all, Monday, October 6th, we're being visited by Spire Energy. The internal auditors are going to be coming there. With internal audit manager was here from Meet the Firms a few weeks ago and really wanted to contribute. So there's a couple things that are going to be associated with that. So first and foremost, the one that's most relevant to you all right here, right now, is an additional assignment I made. Then you're gonna be like, Dr. Barnes, don't give us additional work. And I say, that's the name of the game. That's what I'm supposed to do. It's actually not that onerous. If you go down to chapter or to week 6 on Brightspace, you can see a new assignment here. I said that I submitted an assignment. Where the heck is it? Okay. Did I put it in week 7? Now I'm really, really confused because I know I created this, but now I'm going to be sad if I created this in. Yeah, it's question for Spire Energy. Where did I put that? It was in the content folder. May have stuck this in like week 8 and just completely totally baffled myself. So hold on. You guys get to see all my moving through Brightspace and how I can. Oh yeah, I put it in week 8. Of course I did. So here's what we're gonna do. We're gonna take this and we're gonna move it to week 6. All right. And now in week 6. Oh, come on, stop this. Just chaos. Okay. Let's see. Let's move chapter 1 discussion up here. Let's move this down here. So basically, it's going to be a question that's going to be due with your regular homework submission on Friday. And what I do with these is whenever I have people who come visit the classroom, I notice that student engagement is really good with listening, but not very good with asking questions. So what I would like for you to do is I'd like you to think about a question in advance, and I'm going to provide these to our speaker ahead of time. So it is a single thoughtful question that I want you to write. And can you use an AI tool to help sculpt this? Absolutely, don't care, okay? But I would like for you to create one thoughtful question that I can share with our speakers, that I can send basically a list of questions, say this is everybody who wants to come up with. It is a 3-point assignment. It should take you no time at all. Please make sure, though, that it is a question that is legitimate and something that you really want to know. It has relevance to what your education is and what you're learning in this class. If you ask a question like, what do you like most about your job? Or what made you want to become an internal auditor? Not only will you not get points, but I will throw something at you the next time I see you. Okay. So, because that's a throwaway question. Anybody can write a question like that. I want thoughtful, articulate questions for this. So take like 5 minutes and earn yourself 3 extra points. And think about that. Also with Spire Energy. So I know that many of you are planning on going to public accounting. I already have job offers or job plans as far as you're going. Part of the reason they're coming here is because they want to educate people about what the possibilities are in internal audit. If you have some interest in that, specifically if you have interest in internal audit, that is a possible career path. Or if you have just interest in Spire Energy, I am going to be taking them to lunch right before this class over at the Student Union, and I'm going to invite 5 students to join us so they can have a discussion. So not only do you get to develop your network and rub elbows with the people at Spire Energy, but free lunch. All right. So that's something to think about. Please email me, let me know if you're interested in that. I can't guarantee that I will include you, but I will consider everybody who wants to join, and I'll let you know if you want to come in and join us. So yeah, so please think about that. Let's see what else we got. All right, so before we start today, I want to remind you that you have a homework assignment that has on your discussion question. It's going to talk about Dixon, Illinois. This is just kind of a gentle nudge or something to think about. There's actually the movie about the fraud called All the Queen's Horses is available on YouTube. I think it's available with ads, but it's absolutely free. So if you find yourself with a little bit of free time, which I know is a big ask because you're Truman students, but if you find yourself with free time and are interested in it, you can watch it and talk there in detail. There's what we're going to cover is pretty good as far as the case details go, but it doesn't even come close to covering the whole nuances of the case. And I think this could be beneficial for, especially for those of you who are interested in audit in the future, to kind of look at that as a possibility. But we're gonna, regardless of whether we do it, we're going to talk about this particular case next on Friday, and there's a lot to it. So anyway, today we're going to wrap up chapter 6, and we're going to talk about some very general stuff, and then we're going to get into a little bit more nuance. We're going to talk about our discussion case here. So let's go ahead and let's remind ourselves what we talked about before. So remember last week, or sorry, last Monday, not last week, last Monday, just this, I guess, 2 days ago, Monday, we were talking about this topic. We had this idea that controls are really, really important on a transactional basis. These are security measures that firms put in place in order to be able to address risks that's present. Our responsibility as auditors is going to be address those particular risks. And so I presented something that I developed to you, and I'm very, very proud of, and something that it's in the slides, but I also want to put this up here, called the control sequence. And so, yeah, this is one of those things that I'm really, really fond of to talk about, and this illustrates the relationships that you need to know for this particular course. Now, the basic relationship, what we learned back in AIS, is a control is simply a response to a risk. So you identify the risk, you create the control. The COSO framework tells us that, says entities risk assessment followed by control activities. This is a sequential process. What do we need to know as auditors? As auditors, we need to know that risks are characterized by management assertions, which basically means that whenever we say a risk, we say, what is management asserting with respect to that risk? So inventory is our notorious example, the one that I've used the entire semester. They put inventory on the financial statements, and we know that inventory could be misstated. That is a risk. What are the assertions that are relevant to that particular risk? Existence and VAA were the two major ones that we identified. So we characterize our approach to this risk as auditors through these management assertions, which means that controls should relate to specific assertions. That's going to be very important as you do your testing for your homework on Friday, because that's one thing you're going to identify. There's going to be specific controls in place that are relevant to certain assertions. By the way, you will notice that some of the assertions they list include authorization, which isn't a real assertion, but they continue to list it as an assertion, ignoring the fact that it's not a real assertion. Each of these controls are aligned with specific assertions. So that's something that to consider about how the nature of the assertion is tested through a specific control. We as auditors are testing these controls, testing to make sure that the control is not only effective, but that it's in place, but it's operating effectively. As part of that, we have to validate that the appropriate level of detail is present, that the control is operating correctly, and that it's addressing this assertion that it's supposed to be addressing. So a lot of detail goes into those test to controls, and so it's something that we need to keep in mind as we're moving forward. This all emanates back to what we talked about back in chapter 4, this idea of control risk. And remember when I talked about this a little bit on Monday, I said that there's two primary steps in this. There's the assessment of control risk and the actual or achievement of control risk, or determining what the achieved control risk is. So let's go ahead and break that down a little bit, because this is a really important concept to understand, that there's 2 points in the audit where we can actually assign control risk, and they mean different things. So remember when I talked about the assessment of control risk, that's preliminary. That's something that occurs during risk assessment. Based on our understanding of controls, we are going to make an assessment of what we believe control risk is. That is not the final analysis. That is not the final dictate of what we believe that control risk is. That is just a preliminary assignment, Now, a couple of notes a couple of items to note. We can adopt either a substantive strategy or a reliance strategy. If we decide to adopt a substantive strategy, remember that means that we are not going to test controls. We're going to rely on substantive procedures instead of controls. We have to set control risk at high. And the reason for that is fairly straightforward. It's fairly obvious. If we're not testing controls, we don't know anything about the controls. We don't know what the control risk is. So we're going to default to saying that control risk is high. All right. Which in most scenarios is going to get a result in a risk of material misstatement is high, which detection risk is low, which means a lot of substantive work for auditors. But we accept that because we know that we're going to get all of our assurance through substantive testing, or at least all of our remaining assurance. Now, if we want to set control risk below high, we have to use a reliance strategy. And a reliance strategy, by definition, requires us to test controls. All right, so what are we going to do when we do that testing? We're going to identify specific controls that we need to rely on. Usually this relates to the assertions that we've identified that are relevant to the risks that we've noted. We need to perform tests of the identified controls, and then we're going to conclude on the achieved level of control risk. Now, what is different between achieved control risk and assessed control risk? Assessment is beginning, okay, before we've done any testing. Achieved control risk is after we do the testing. We know what the actual results are. We basically revise our assessment and say, this is what the true level of control risk is. Now, I want to make a note of this. This is something that's consistent. It's used in the CPA exam. It's common vernacular, but people are sloppy with their terminology and use this. Oftentimes they'll say assessed control risk, and you have to actually interpret based on what point in the testing you're at to determine, are we talking about the original assessment of control risk, or are we talking about an assessment of control risk later on? So keep in mind that just because we're using in this course, just because we're using the words assess control risk and achieve control risk does not mean that they can't be bandied about and used improperly. Sometimes you will see the book say something like control risk was originally assessed at medium, audited then reassessed it at high, so assessed control risk is now high. Basically what they're talking about in that scenario is that they're talking about achieved control risk as the result of testing, but they will still use the term assess control risk. So make sure you're understanding the difference there. All right. In performing test of controls, there are certain tests that we can perform. Now, we're not going to get into too much detail about the nature of test of controls. We're going to look at an example of how we conduct test of controls as part of our homework, and we're going to talk about them at a very high level. Right now, we're at a theoretical point. We're talking about conceptual ideas. We're talking about conceptual points. But specifically speaking, when we talk about test of controls, what are some of the tests that we could perform? So let's assume that we're looking at accounts receivable. Okay, we're looking at how accounts receivable and cash in this area. What are some types of tests we perform? Well, generally speaking, there are 4 tests that we've identified. So 3 of these we know: inspection of records and documents, observation, inquiry, and then we had that reperformance thing. There was a 5th one also. Does everybody remember what that one was? Walkthrough is good. We'll talk about that in just a second. The 4 of those are listed over here. Now, these are examples of how these would be applied in actual practice. So when I say inquiry of appropriate personnel, okay, appropriate entity personnel, let's say that I'm concerned about uncollectible accounts. I want to make sure testing my balance for accounts receivable and the corresponding contra asset, the allowance for uncollectible accounts, are valued properly. What would be my first step? I could talk to the credit manager and say, help me understand the process for developing an allowance for uncollectible accounts. That would be an example of a procedure specific to that particular task. It's still an inquiry task, but it's more specific in language. And keep in mind that as we move forward, one of our optimal goals in this course is going to be not to say we're going to be using a test. We're going to frame that test specific to whatever process area we're at. The good news is we're not there yet, okay? That becomes really, really challenging and complex. The bad news is we're going to be there very, very soon. After week 10, we're going to cover our business processes, and all this is going to come crashing down, because then you're going to be saying not just inquiry, but inquiry of which personnel and what information are we trying to derive. So this is an example of the alignment between the types of controls that we are test of controls and how these would be framed for specific tests. Now, while we're here, I want to talk about that walkthrough thing, because we're going to see that come up. And fortunately, it doesn't get used very often in this particular course, but it's still enough that we need to be able to understand what a walkthrough is. So originally, I basically said a walkthrough was a combination of the other 4 types of test, which is not incorrect. But a more specific definition would be following a transaction through a client's financial system from inception to inclusion in the financial statements. So basically speaking, in order to perform a walkthrough, we look at a single individual transaction. We look at where it goes into the system. So if we're talking, like an example would be a purchasing transaction. So I'm talking about purchasing with my AS class today. So a purchasing transaction. What would initiate a purchase transaction? That would be a purchase request by a department and say, please make sure that we get these items because we need these items in the future. So you have a purchase request, which generates a purchase order, which generates a receipt of goods, which generates an invoice, which generates a payment, which generates a disbursement. All of those steps are what the controls would walk through in order to understand how a transaction flows through the system. We as auditors would take a single transaction and we'd walk it through every single point to make sure not only does it follow the system sensibly, but are all the appropriate controls that are along this process in each of these steps in place? And are they working properly? If this single transaction that we perform hits every single control and triggers the proper controls or doesn't trigger the proper control, depending on the nature of the transaction, we can be satisfied that the system is working properly. The reason a walkthrough is so powerful is because even though it only looks at an individual transaction, it looks at all the controls in a process area simultaneously. So that's why we tend to rely very heavily on walkthroughs. Walkthroughs do take a substantial amount of time because you have to walk it through every single point in the system, but they provide a lot of assurance, mostly speaking because they're a combination of all these procedures. All right. Just as a reflection, what we talked about, that's this slide, just basically the same thing for achieved level of control risk. Just as a reiteration, this achieved level of control risk is our final assessment of what we believe control risk is, our final conclusion on control risk. This is usually how we dictate what we believe risk and material misstatement is. And risk and material misstatement concludes leads us to a conclusion about how we're going to assign substantive procedures. So just as a reminder, if I have high control risk, which results in risk and material misstatement being high, detection risk is low. Is detection risk being low a good thing? No, it's not. That means that we can't tolerate very much risk and we have to do a lot of work in substantive procedures. What about control risk being low? Control risk being low, risk and material misstatement is low. That means detection risk is high. We like that as auditors because we can tolerate a lot of risk. We have to do less work. Also, it's important to note, we're going to see this distinction a lot more when we get to the process areas. But what is the difference between test of controls and substantive procedures? I keep talking about that, and we've alluded to it already. But with respect to controls, what was the category of assertions that I said was most applicable to controls? So we have two categories of assertions. We have transactions and events and account balances. Which one do you think is most relevant to controls? To transactions and events, they actually coordinate over day-to-day operations of the organization, okay? An invoice is created, it has a control that you check to make sure the invoice is properly authorized, something along those lines. So very heavily based on transaction events and testing transactions and events. Now, what eventually happens to all the transactions and events conducted by an entity? Where do those flow to? The financial statements, okay? So we are going to incidentally, by testing transactions and events, we are incidentally testing account balances. But substantive procedures, while they can test both transactions and events and account balances, are largely concerned with the information in the financial statement. So when we perform substantive testing, we're trying to determine, is the information in the financial statements presented properly? Is it properly documented? Is it fairly presented? Is it free from material misstatement? We're going to the very end of the result, the generation of these financial statements from the accounting system. Now, there is a relationship there, but they are considered separate testing areas. So when we talk about those, keep in mind here that test of controls naturally flows into substantive procedures. Substantive procedures is just basically where we determine what our final work that we need to perform is. We can perform additional testing of transactions and events, but largely we're going to be concerned with making sure the account balances and the financial statements are accurate. All right, let's talk about interim testing. So has anybody heard the term interim testing before? Has anybody encountered that? Well, one thing that you will encounter if you go off to work in the real world, and this actually in public accounting, this actually is applicable to both audit and tax, is that a lot of the work that's performed does not necessarily wait till year end. A lot of work is going to be performed prior to year end whenever possible. And so this is considered to be interim testing, okay? So audit procedures in particular, they can be conducted either at an interim date or a year-end date at period end. Now, let's think about why that's the case and what are the relative advantages of each of these. So an advantage of interim testing is that it allows the auditor to complete some testing prior to year end or period end. Now, can we say that's an advantage to try to get some of our work done early? Yeah, imagine you're preparing for an exam. Imagine you're preparing for an exam in this class and you say, I'm going to wait to study until we get to right before the exam. I'm going to wait to the day before the exam and I'll just get it all done at once. which many students have done in the past, by the way. It doesn't usually go well, okay? Does everybody see a problem with that, trying to learn everything in a single day? That's a lot of information. That's a lot of work to do, okay? So waiting until the last minute may not be helpful. But this says a disadvantage in interim testing is that it's typically less effective than year-end or period testing. Now, why is that statement true? Why is that statement the case? The answer is pretty basic. It's because not all information is available at period end, particularly the information that's relevant to balances in the financial statements or information in the financial statements, because the financial statements have not been generated yet. Now, silly example, the one that I've always used, and you're gonna laugh at this one, the silly example. If I were to give one exam, a single exam in this course, okay, which would be the most effective test of your knowledge? A midterm exam or a final exam? I know people don't want to answer this because he's getting ideas if I answer this question. I promise you, I'm not going to change the test structure, okay? But which would be the most effective test of your knowledge? Would it be a midterm exam or a final exam? A final exam, because we've covered everything in the course, and that would be the most effective test. If I relied on an interim exam, there's going to be 1 to 2 problems, okay? If I made the interim exam comprehensive, you'd be like, half the questions on here we haven't even covered in this course yet. And then just be really, really upset and angry and disappointed, okay? The other possibility is that I can give you an interim exam up to the content we covered that point, and then you come back to class and said, well, we don't have any more exams in this class, but I still expect everybody to attend and pay attention. What's going to happen to the attention level in this class if there's zero more exams? Yeah, everybody's gonna be like going to social media right now, talking about how Dr. Barnes is the most boring professor ever. Yeah, I am not the most boring professor ever. I am at least in the third quartile. Okay, at least in the third quartile, somewhere around there. All right. So yeah, same idea holds true. Is that we want to make sure we have as much information as possible to be able to make a decision. That being said, interim testing can be very effective. Why are we including this here? Because interim testing could either be related to controls or substantive procedures. But we're talking about it with respect to controls. Part of the big reason why we want to talk about it with controls is that interim testing over controls is very prominent. Does that make sense? Well, let's think about a control. If you have a control that you have to an authorized signature on a document, a purchase order document, let's say, a purchase order authorized signature, is that control going to operate the same way throughout the entire year? Hopefully so. Hopefully so. Hopefully you don't get to November and say, we're done with doing signatures this year. We're going to wait till next year to pick up signatures again. Hopefully the control operates the same exact way every single point during the year. So if I tested in July, do I have a lot of assurance that the control will still be active at some point in the end of the year, like in November or December? Hopefully so, okay? The controls shouldn't change that much. Most controls are relatively stable. Once they're established, they operate that way consistently. So testing those controls early is generally not a problem. Now, we're going to talk about this more in chapter 7. We're going to walk through an example of a test of a control, and we're going to talk about follow-up procedures that are performed for year end. But usually what happens is when we perform interim test, we do have to still perform some year-end testing in the area. But we can accomplish most of our testing, a big part of our testing, beforehand. So what are some reasons an auditor might contest controls at interim date? One big reason is that the assertion tested may not be significant. So we're looking at assertions and I'm saying, okay, I'm going to test controls over inventory. What did I say my 2 big assertions over inventory were? We were just talking about them earlier. Existence, assurance, and valuation, allocation, accuracy. So I look at clients' controls and they've got some controls related to completeness and authorization. And I say, well, authorization is not even a real assertion, but ignoring that, okay? I look at those and I say, I do want to test those controls, but they're not really significant assertions. Could I get that done at interim and get at least enough assurance that I could write off on them? Presumably so, because I don't think they're significant assertions. What if the control has been affected in prior audits? What did we just say about the stability of controls? Controls don't change a lot from period to period. If it was effective last year, is it likely to be effective in the current year? Hopefully so. Hopefully so. Also, it may be more efficient to conduct the tests at that time. Efficiency is something we're striving for in auditing. Remember, there's always going to be a lot of work. So if we get some of our work done early, it means less work to do later on. Less work later on is definitely a good thing. So that's something we can keep in mind. What about some other reasons that might be more efficient? What are some reasons? Staff accounts may be less busy during interim. So yeah, imagine if every single one of your instructors said, we're going to just do one exam and a final exam. Truman students would never sleep during finals week. They'd just be going crazy. They'd be losing their minds. Okay. So having that ability to be able to get some of your work done, some of your testing done out of the way can be good. And if you got a really good instructor, they may say final exams, you can opt out of that if you get the right situation. Only those really good instructors do that though. Yeah. All right. Hint, hint. Yeah. All right. Testing controls at interim date maybe give the auditor more time to reassess control risk and modify the audit plan if controls are found to be deficient. So this is something interesting. Let's say that I assess control risk at low, but then I test controls and I find the controls are not effective in a given area. Can I reassess control risk? Yes, I can adjust my assessment and say control risk is actually higher than I thought. That's going to change my substantive procedures later on in the audit. So doing some testing in interim can actually allow me to reassess. The same is reverse is also true. Say if controls are far more effective, I could actually set control risk at lower and I can change my audit plan for later on and do less work. Also, interim testing enables management to correct any identified misstatements or remediate any control deficiencies prior to year end or period end. This is a big one we're going to talk a lot more about in chapter 7, this idea of remediation. If there's a problem with controls, that doesn't necessarily fix the time period that the controls have been operating there, but we can correct the controls to fix the remaining time period. So say a control is found deficient at the middle of the year, somewhere around like beginning of July. Auditor comes in and say, yeah, this control is really, really bad. You need to fix this control. And management does that. It can allow the auditor to basically say that the control itself is now effective as of the year-end date. So to give the chance for our client to fix any problems that we identify early enough. What are the cons of interim testing? Okay. Cons, interim testing, they may increase the risk of material statement that control deficiencies are present. Again, we do not have all the information we need to come up to a thorough conclusion. So that may lead to an incorrect assessment, may lead to a risk or problem of a misstatement. Now, how can the auditor control for this potential problem? One, we can consider when it's appropriate to examine an account at interim date. So this is going to be something to note that sometimes we may not be able to test an interim date. Sometimes we can get away with it, but we need to have the wisdom to understand when the difference occurs. Usually if it's something highly significant, highly concerning, we probably need to wait till year end. Also, we can perform selected procedures for the period between the interim date and year end. This is an important one, by the way, and one that you will encounter. If you go into auditing, you will encounter this in actual work. What this means is that the client will do some interim testing for the client, and then at year end, we'll say, we tested most of the transactions in this particular time period at interim. There was a window of 2 months between the time that we tested interim and the time the year end occurred that we have not tested any transactions during that period. We can test more transactions to get additional assurance for that period under audit. So that would be an example of how this would be appropriate here. All right, I've got a couple slides. They're going to be wrap-up slides. First one I need to talk about is service organizations, okay? So an organization provides accounting services to an entity. Those services are considered to be part of the entity's financial reporting system. This is something that's probably more relevant to AIS, and I probably talked about it in AIS class. But basically what this means is that organizations are becoming more and more integrated nowadays. The way this used to occur back in the 70s and 80s is that really large corporations would say, we don't necessarily, or not really large, but larger corporations, not super large, because most large corporations have all their operations in-house. But like a medium-sized organization may say, we have enough resources to conduct our basic business model, but ancillary and support services, we may not have the expertise or have the desire to try to support that. One of the big areas that this was prominent one was payroll. A lot of organizations that are not super large tend to outsource their payroll services. Has anybody ever heard of ADP? They're a big payroll provider, big payroll out service provider. And so basically what that means is ADP is given the payroll information and they perform the payroll tasks for us. Now that's great because that means that we can rely on their expertise and their personnel and their structure. It's also problematic because now they are a part of our control system. They are part of a control system. They have sensitive data. They perform transactions that relate to our financial reporting. Anything that goes wrong there could be a reflection on things that are problems that control in our client's control environment. So one of the auditor's concerns the internal control system is the internal control system in place of the service organization. Now, optimally speaking, if I had all infinite time and resources and I had the infinite desire to do so, what would I do in that situation? I would go and I would test the controls in place at the service organization. I would say, ADP, open up, I'm going to test everything. Now, that's not feasible for a number of reasons. First of all, I don't have infinite time and resources. Secondly, ADP is likely to say, go away, all right? They would probably say that to my face. Yeah, we're not letting you in here, okay? You're not our auditor, you can't do it. The compromise has come in as something called a systems and organization control report, a system and organization control report, or a SOC report. Now, you will notice that I don't actually write out system and organization control reports. When I originally created this slide, it was actually called a service organization control report. It wasn't until recently they changed it to a system and organization control report. Whichever term you use, they're basically mean the same thing. Is a report on controls in place at a service organization. Now, interestingly enough, for SOC reports, there are 5 different categories of SOC reports, okay? By the way, if you're considering about doing SOC report for your group presentation at the end, remember there are 5, okay? I will be testing you on that and look there. Only one of these is specifically relevant to financial statement audit, and that is a SOC 1 report, a SOC 1 report. A SOC 1 report is actually over controls related to financial reporting at a service organization. Internal controls over financial reporting. Have we heard that term before? ICFR? Internal controls. Yeah, that was at the beginning of chapter 6 last Monday when I said, remember the objectives reporting related to financial reporting were the most important objectives. So we're going to be very concerned about those controls that are in place at a service organization as well. So SOC report relates to internal controls over financial reporting in place at a service organization. It is prepared by a secondary auditor, an auditor that works for the service organization, and it provides some level of detail about the controls that are in place. Now you'll notice I was not very specific about what level of detail. The reason why is there are 2 separate categories of reports, all right? There is a SOC 1 Type 1 report and a SOC 1 Type 2 report. Now, waiting with bated breath. What is a SOC 1 Type 1 report, Dr. Barnes? What is a SOC 1 Type 2 report? Hold on, I'm getting there, I promise. Okay. The excitement is palpable, all right? So a SOC 1 Type 1 report relates to internal controls over financial reporting, but it specifically relates to controls in place at a point in time and only checks the design of internal controls. So it's the auditor's opinion on the design of controls in place at a point in time. Now, if you're the client auditor and you get a report like this and say, all right, I know what the design of controls looks like at a point in time, how much assurance does that give you? Yeah, that's exactly what I was looking for. It's like, okay, it's some assurance, but it's not a lot of assurance. Generally, we use a SOC 1 Type 1 report when we don't need a lot of assurance about the client's operations. They form a minimal amount of infrastructure in the organization. By far more prominent, more assurance would be derived if we have a SOC 1 Type 2 report. A SOC 1 Type 2 report gives an auditor's opinion on the design and the operating effectiveness of controls in place over a period of time. So auditor's opinion of the controls in place, or the design and operating effectiveness of controls in place over a period of time. Now, just to summarize what that means, okay, SOC 1 Type 1 only deals with design of controls and is for a point in time, like December 31st, 2025. SOC 1 Type 2, design and operating effectiveness. Both of these are very prominent. We've talked about them already, okay? And it covers a period of time, January 1st to December 31st, 2025. Now, if you need a lot of assurance, you're the organizational auditor, you're going to say, give me a SOC 1 Type 2 report. It is a lot more thorough, a lot more detailed, provides a lot more assurance. It's also a lot more expensive and a lot more time consuming, okay? But that would be the option. If you just need a little bit of assurance, a little bit of a reassurance about the organization's control infrastructure, SOC 1 Type 1 only is designed and only at a point in time. So understand the distinction is there, which is funny because I just spent like 5 minutes talking about one category report and I said there's 5, okay? So good luck whoever gets SOC reports. All right, if anybody covers SOC reports. Anyway, last thing I want to talk about. This is a spoiler for chapter 7. So we're going to talk about these terms about how we categorize internal controls over financial reporting, specifically if a control does not work, if a control is found to be ineffective. So our general categorization for this terminology is going to be something called a control deficiency. And a control deficiency exists when the design or operation of a control does not allow management or employees in the normal course of performing their assigned functions to prevent or detect and correct misstatements on a timely basis. Basically, something related to the design of the control or their operation of the control allows for failures to occur. Now, this is a general categorization. It's also considered to be our lowest categorization. Moving on, we've got two separate categorizations that are related to that. Let's say we have a control deficiency that we consider to be significant, but not material. That would be a control deficiency known as a significant deficiency. Now, all a significant deficiency is a control deficiency that we believe is significant, but not necessarily resulting in a material misstatement, not likely to result in a material misstatement. Now, I'm going to leave it at that for right now. I do have some better explanations moving on a little bit later on, but I'm going to leave it right now. Just think about it. It's significant, but not material. If it's likely to result in a material misstatement, we consider that to be a material weakness. That is a control deficiency that is likely to result in material misstatement. The control is so bad, and it's such a prominent area of the client's operating system that are operating and reporting that it's likely to result in a material misstatement to the financial statements. And you can always judge the severity. It's going to be a higher severity for material weakness versus a control deficiency. A control deficiency is just a problem with the control, but it may or may not be relevant or significant. All right, so hold on to that because we're going to come to those terms a lot. And this terminology is going to be really important for us for Chapter 7. You may encounter this terminology in your reading in Chapter 6. It will become very heavily to play in Chapter 7 when we start talking about internal controls or financial reporting. For right now, we're going to go back and we're going to visit our good friend Sue over at Cost Corporation. So is anybody reading through this and just kind of like saying, oh, okay, that was outrageous. I can't possibly learn anything more, okay? Let's go ahead and review what's going on. So basically, Sue Sackdave, remember our good friend Sue, she stole $34 million from $70 million of income. Yeah. So she had an accomplice. She had Julie Mulvaney, who was the senior accountant, and had to basically create these phony transactions that allowed them to get away with this fraud. So it says that they hid embezzlement by making false entries in the company's general journal, by overstating assets, expenses, and cost of sales, and understating liabilities and sales. And then the binders detailed numerous false journal entries that made the company's book of records. The reclassified company's funds with no documentation or individual explanation. Also, a series of folders that represented over 100 fraudulent transactions that were included in the company's accounting books and records. So the good news is Julie was thorough, all right? She actually maintained her fraud separately and kept those in separate books. I don't know. My assumption is that Julie Mulvaney probably was not a good person either. But I always get this like abusive relationship thing in my mind. Is like Sue just is like saying, oh, committed fraud again. Can you help me cover it up? I promise this is the last time. And Julie's just like something. Okay, you poor dear. That's just fine. And then a week later, when Sue has done it again, she's like, oh, as long as this is the last time, I'll let you cover this one up. And it just was kind of like ongoing and repetitive. That's the way I characterize it in my mind. It's probably not that way. Okay, that's the way I think about it. So company did not maintain adequate quality controls to obtain reasonably assure the accuracy and reliability of financial reporting. Control policy required Michael Koss to approve invoices of $5,000 or more from payment. Now, what we know about Michael Koss is he probably did that very diligently, okay? He was a very, 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 very determined leader. I mean, he held 5 executive positions, so he had to be very, very close to attention to details, right? So he probably did. No, he didn't do that. He delegated his duties to Sackdeva. So basically said, hey, I know you're committing fraud. Can you go ahead and authorize your fraudulent transactions? Yeah, he probably didn't say those words, but that's effectively what he did. Many cashier's checks exceeded $5,000, with some exceeding $100,000. So yeah, certainly problematic. $100,000 in fraud going on. How does this happen, by the way? Does anybody know? Like, how did she actually get away with $100,000 of fraud? And the answer is frauds are naturally self-escalating. All right. Something that we talk about in forensics circles is the idea that if you steal $1, you're probably not going to be held to any scrutiny. Even if somebody sees you do it, it's like, that's just $1, okay? But you get away with $1, it's like, well, that was easy. Then you steal another dollar and another dollar, and then you go up to $2, then to 5, and then later on you get to 20, and then all of a sudden you're stealing everything. Then all of a sudden you're stealing everything because you just think nobody's paying attention. And the funny part is, oftentimes nobody is paying attention. Nobody is paying attention. They trust you. And so that's something a theme we're gonna see. We're gonna see it again on Friday. So these wire transfers and checks out accounts payable for pay for SAC data is purchased without seeking micro cost approval. And in condition, many account reconciliations are not prepared, maintained, or reviewed as part of cost accounting records. Account reconciliations. Have you done reconciliations in any of your accounting classes before? So like those bank reconciliations from like 220 and 302. Did you enjoy those? Probably not, but were they important? Yes, they were very, very critical. Reconciliations are important to be able to understand that what we say we have is what we actually have. By the way, for those of you who are excited about more working, we're going to talk about how to audit a bank reconciliation at the end of the course. So if you thought you were getting away from bank reconciliations, I'm sorry. I'm sorry, but it's going to be coming up. All right. So in addition, many accounts. Okay, sorry. Cost of computerized accounting system was almost 30 years old. All right. So let's talk about the questions that are on here, and then I've got some additional questions for you. List the major internal controls that are absent within cost of corporation's internal control system. Now, this is low-hanging fruit, guys. You probably should have been able to identify 5, like with no thought whatsoever, but we're not going to talk about everything that's listed there. The easiest one is probably one that, you would say, well, it's Dr. Barnes. I've got to say this one. I know that Dr. Barnes is going to ask about this one. It's 3 simple letters. What are they? CAR, custody authorization and recordings, no segregation of duties, okay? Now, even if we say that Cost did not delegate responsibilities, he having 5 roles already violates that stricture. And the fact that SAC Dava was being able to do it herself, she was basically able to authorize her own frauds, which is kind of problematic. Some other ones that are outside of so by the way, segregation of duties is violated in numerous different ways here, not just a single way, but you could actually look at, we probably could identify over a dozen different violations of a segregation of duties on their own. But what are some other control failures? Lack of reconciliations, do we think that's problematic? Yeah. Lack of authorization for large transactions. It's computerized system, that's not really a test of controls, but could we say that's a control failure? Yeah, so problems with the computerized accounting system being 30 years old, all right? 30 years old, so this took place in late 2010. So if we're talking about a computerized system that's 30 years old in 2010, we're talking about late 70s, early 80s. Has anybody seen a computer from that time? Yeah, they did not do much, okay? They did not do much. They were not very secure. Definitely not that internet capable, okay? So certainly problematic with security and protocols in place. What internal control should be implemented to apply to ensure proper controls of the company's recorded transactions? Well, basically, we can identify the controls that are absent and just reverse engineer those. Definitely needed to be more segregation of responsibilities. So that would be certainly an adequate one. I think also implementing a new information system that was had a much more recent structure, something that can actually handle the threats in this day and age. Again, we're talking about something that was like 2000, 2008, 2009, 2010. If we fast forward this to 2025, could we even come close to getting away with a 30-year-old system? We'd have no cybersecurity infrastructure whatsoever. This place, the organization just getting cyber attacks left and right, okay? So yeah, certainly problematic in that regard. All right, what were the questions that I asked? Let's go ahead and take a look at those. Based on the limited facts provided in the 2 cases, assess cost of internal controls using the COSO integrated framework. All right, what's our first component? Control environment. What do you think about the control environment in place at costs? Yeah, you don't even need to say any words, just shake your head, okay? There was no control environment. Costs did not take anything seriously, therefore nobody else did. Risk assessment. Were there risks? Were they assessed? Nope. Okay, so that failed. Control activities. We already just talked about that. The control activities themselves, they didn't assess risk properly, so they can't implement controls. Was there strong information and communication in the organization? Of course there was. There was information and communication from cost saying, Sue, do my job. Okay, that was about all the information we need, communication we need. What about monitoring? Did they update according to new risks? What is the single biggest indicator that they did not properly update to address new risks? The old system, a 30-year-old system. Do things change over 30 years? Like, do you think that the classroom that I worked in 30 years ago, or that I did my coursework in 30 years ago, is the same as the classroom now? No. That's what's part of the reason why I'm not tax, is because we had to actually write things by hand, and my tax professor had horrible handwriting, like worse than mine. Like legitimately, when he would write $1,000 on the board, it'd be like like that. Yeah. Okay. I'm not even exaggerating. It was that bad. Okay. Yeah. So Dr. Caden at least has pretty handwriting. I think I might have been a tax person had I had somebody like Dr. Caden teaching a class. Don't tell her I said that. That's being recorded. Never mind. Okay. All right. Recall from discussion case 433 that cost is not subject to testing or controls over internal controls or financial reporting of SOX 404. Despite the lack of test controls, cost auditors were still required to obtain an understanding of internal control. Do you think that just based on this limited information, they were deficient in their duty to obtain an understanding of cost of controls? I think that there was a big deficiency there. I think there was a big problem there. No auditor should walk away saying, all right, 30-year-old infrastructure, I'm perfectly fine with. Lack of reconciliations, lack of segregation duties, there's not a problem there. I think that they should have been able to identify this. This would be very easy, very, very transparent to note. At the very least, they should have been able to say, you've defeated the entire purpose of internal controls by assigning yourself 5 positions, Michael Koss. So that would be an easy one that you got to identify without doing any testing of controls. You could say that it's problematic. All right, here's the $100 question, which why I say $100 question, it means if you get it right, I give you $100. At least that's what I'd like to do if I had extra money. I'm not going to give you $100. Sorry, guys. But if you get it right, then you can think of yourself, ooh, I got a virtual $100 from Dr. Barnes. Okay. Maybe one day when I'm a billionaire, you can make it come due. The case notes that SUSAC data colluded with Costa's senior accountant, Julie Mulvaney, to conceal her fraud. Would a properly designed system of controls been effective in preventing this collusion? What do you think? If you see a few people shaking their heads, and a lot of people are ignoring my gaze. So we don't know, Dr. Barnes. We're ashamed about this. Okay. Does anybody think it would have been effective? Does anybody think it wouldn't have been effective? The no's have it. No is correct answer, but why is no a correct answer? What's the key word there? Yes, collusion. What did we talk about with collusion at the end of last week's lecture? Said that collusion is an inherent limitation of internal control, just like Kate said. Yeah, it's an inherent limitation. Now, would it have made it harder for this fraud to occur? Yes, a good system of internal controls would have definitely made the fraud more difficult. Wouldn't have been completely effective because, as we know, they were already collaborating. The senior accountant and the chief or the controller were already collaborating to bypass the controls. So, assuming that one had one reporting area, the senior accountant had reporting responsibility and SUSAC Data had authorization responsibility, they could bypass those controls by working together. So that is one of the big issues of collusion. Now, just speaking frankly, how would we as auditors approach this if we encountered this? We probably want to look at the transactions and say, it seems like the same 2 people are doing these really large transactions, and it seems like there's like some sort of trend going on here. We'd want to be very cognizant. It's not necessarily our responsibility to try to identify if there's going to be a collusion going on, but if we become aware of it, we do need to be aware of the dangers of that. What is a bigger concern? What is a bigger concern? Is it collusion, or is it the lack of just any kind of separation of responsibility whatsoever? Like if you have one person that has all responsibility areas, should that be a big red flag? Why do I mention that? Might it be relevant to our homework on Friday? Yes. So as we're wrapping up here, I want you to think about that when you go into the homework on Friday. Is that collusion is bad? The need not to collude is much, much worse. So that's something to consider as we move into Dixon County or Dixon. I keep saying county, Dixon, Illinois, with our discussion for our problem next week or next Friday. All right, we're done today. Homework on Friday. Talk to you then.